those of you who don't know me, my name is Omar Ayales. I'm editor and chief trading strategist of Gold Charts or Us. It's a weekly trading service, part of the Aiden Research Group of newsletters. And giving our theme today, and in this conference, I think a lot of you are going to be very excited to what I have to say. We're living very exciting times for the metals and mining as the end of the cyclical bear market in precious metals is in sight. Years of strengthening deflationary forces have been putting downward pressure on the metals. Slack in global demand amid a sluggish recovery from the crash in '08 was partly at fault. The growth of a giant commodity-eating monster that was China was moderating, and so was its need for commodities and metals. The overly leveraged world we live in had fallen to unsustainable levels of growth and production. Interest rates were slashed. Unprecedented amount of quantitative easing was injected into the economy. The euro was starting to show cracks at its foundation. Greece was on the verge of leaving the union. Fear and uncertainty were at a high when gold peaked in September of 11. Interestingly, a spiral towards deflation would start at that moment and would last several years. Intensifying deflationary forces fueled the liquidity crisis, pushing the dollar up as the world sought cash, particularly in Federal Reserve notes. The dollar started a bullish rise towards the end of 2011 and has been king ever since. However, the dollar has been declining since it peaked in January of 17, and the dollar is now showing signs of a major turnaround, and so are deflationary forces as inflation is finally starting to pick up. And with Mr. Trump throwing the dollar under the bus every time he can, we could be at the onset of the end of king dollar status. This brings me to my first chart, which is the dollar since 2011. You can see in September of 2011, right when gold peaked, the US dollar has been uptrending. Back in April 2014, it basically rised almost like a blow-off, and then eventually entered a sideways band between the higher area around 100, 102, and the lower area between 93 and 94. Just a couple weeks ago, the dollar broke below a 2014 uptrend, which has been key. So I'm sorry my pointer is not working very well, or at all. Here it is. So you see the break, okay? This break is telling us that the dollar could be at the turnaround of its bull market that started in 2011 and intensified in 2014. Basically, our first target for the dollar is going to be the 93.50 level, and our second target is going to be this uptrend since September 2011. If this level is broken, that is going to sink the dollar further into this level and possibly even lower. Like I said, a reversal. This peak marked a potential trend reversal for the dollar. And why is this important? As many of you might know, gold and the dollar tend to move in opposite directions. You can see this chart is gold and the dollar since 1972, ever since Nixon unpegged gold, the dollar to gold. You can see that ever since that time, the dollar has been downtrending, gold has been uptrending. Okay, with the exception of certain instances in which they have moved together, the trend is clear. So basically, the dollar, with its fall, its recent fall, which in this chart you're not going to be able to see because, of course, it's a 40-year chart. But with this turnaround and this turnaround is basically telling us that gold could be at the right moment, not only to buy gold, but the miners, of course, as well, especially the miners. But interestingly, we're seeing the dollar development before our very eyes, and obviously, as it breaks down key support level, it's telling us it's weak. But really, the long-term yield in the U.S. bond has been telling us all along this story. So you see, this chart is from 1945, is the 30-year yield in the U.S. bond. You see that it has been rising, similar to gold. Gold has been rising with interest rates ever since, 1945, until it peaked in 1981. Since then, world central bankers were proud to say that they had conquered inflation. Ever since that moment, since inflation peaked with interest rates, inflation started to decline, as did interest rates. It broke, this must have been around 1985, it broke below this moving average that we followed, this trend, this 80-month moving average. And ever since, you see that it has been resisting right at it. It has not risen above it, showing that inflation has consistently been falling. Little did anybody know that that fall in inflation would eventually turn into a deflationary spiral that would basically push the dollar up, as we saw since 2011, and push gold down ever since the peak of 2011. Now, we're actually starting to see a change in dynamics. So if you see this next chart, we're seeing basically gold's bear market since 2011, okay? So you can see this big trend since 2011. Gold has been resisting at this level. Ever since gold peaked, it went into a sideways band for about 2 years. Then it finally broke a key support level of 1536 and went into a downward spiral. This basically was when deflationary forces, if you remember well, were tightening. This was also the period where the dollar rose sharply. Coincidentally, the low coincided with the first rate hike by the Federal Reserve back in December 2015. This marked basically the low. And the reason that's important is because the hike of interest rates by the Fed basically signals that all of a sudden we have a turnaround with inflation. Inflation is starting to creep back upward. Gold went to rise, reaching this critical resistance level, only to fall back down. And where did it fall? December 2016, when the Fed raised rates for the second time in a decade. Basically, those two Fed hikes have been creating a foundation for gold to move upward. I believe this little low right here that I'm signaling right now is March. That was coincidentally the other hike this year, March 2017. And then it rose and resisted. And then it fell and it held. Actually, this little up move is from this past month, which has been actually a very bullish month for gold. And where do we go from here? What does this tell us? Is it going to break above this resistance? If it's going to resist, it's going to fall down. What's going to happen? We call this chart the ABCDs of gold. And it's going to give us a little insight as to what might happen in gold moving forward. The ABCDs of gold is an indicator that at the Indian Research Group we've been developing for the past 35 years. We sounds like a lot of people because I'm 37, so I couldn't, But somebody at the Indian Research Group has been developing this chart for the past 35 years, and it basically marks the different rises and declines of gold within a particular year. So when you see A rises tend to be moderate rises, B declines tend to be moderate declines, C rises are the strongest rise within a particular ABCD cycle, and D declines end up being sharper declines within also the ABCD cycle. So if you see this B decline back in 2015, this chart is from 2014, but this decline since 2015, which was when the Fed hiked rates, you see that the B decline overshot the D decline, something that is not very typical. This extreme weakness told us that there was a trend reversal in play. Ever since, started rising. We saw, many of you might remember, it might have been very profitable for you back in the early months of 2016 when gold rose strongly until about the Brexit, okay, to about 1380. Then it declined on decline fashion, okay? Again, creating what we just saw already, this support level. Gold then had a moderate rise recently, which is this A rise, and has declined since. And actually, what's interesting is that even though gold has been very strong this past month, B decline pressure is still in play. our indicator, which is a series of moving averages that tells us momentum over a period of time, medium term, is telling us that we could actually still see the B decline fall. According to our analysis, the B decline would be over as soon as gold rises above its previous A peak. In this case, it's about 1300, 1305, 1300. So as long as gold does not break above this 1300 level, which coincidentally also is this downtrend, we're going to see downside pressure on gold. So when everybody's seeing what gold's been doing during May, everybody's excited. We want to buy. We want to be in this bullish bull market, of course, and everybody wants to be in it, of course, right? However, I always tell our subscribers, don't be the hero. Don't buy in the middle of a rise when there's still is some downside pressure there. Wait until this 1300 level breaks, or it falls. Actually, our B decline support level is right here, which is getting close to about 1200. It's about 1190, 1200, which would be an ideal place to buy. This other moving average that you see, it's a 23-month moving average. Currently, it's at 1213. Has proven to be also a place where gold likes support, has support. However, this uptrend and this 23-month MA are very likely going to meet near term. And if gold fails to break above the 1300, it is very likely that it'll give us another opportunity to buy at this level. And yes, gold, of course, is a great investment. It has a great potential for upside. We're just at the onset of a C rise, which could basically see gold rise to about 1300. That first resistance, if it breaks above that level, we could see it go to 1536, which used to be a key support level back when the bear market started. But of course, the greater opportunity within the gold universe lies in gold shares. So if you see this chart is showing gold shares since 1968. And basically, this is the Barron's Gold Mining Index. The reason we use this is because that's the index we have most data from going back. Okay? So you see this uptrend, how it's fluctuated, and basically this channel has been pretty constant over the past almost 50 years. You see how gold shares decline sharply, actually below the bottom side of this channel, and has spring upward, showing us that every single time, or the past couple times that it has reached this uptrend, it has gone up and risen to this top channel. So the potential for gold shares to reach this top channel is very high, is very likely, given where it is right now. Also, this other chart shows gold to gold share ratio, gold shares to gold ratio. This chart is since 1971. This chart obviously clearly shows that gold has been stronger than gold shares since 1971 on a mega trend basis. Of course, during those times, gold shares have outperformed gold on different occasions. At this point, the reason why we like this chart a lot is because we see that actually gold shares have declined extremely low and are starting to bounce up. The potential for gold shares to actually reach this downtrend is high, and it might not even change the trend between gold and gold shares. That relationship could still maintain downtrending, but the point here is that we actually have a lot of upside potential. Looking at a closer look at the HUI, we analyze in our services. We analyze price movement very closely. So technical analysis is one of our good friends. We don't rely completely on technical analysis, but it is a science that allows us to identify specific price points, targets, entry levels. Okay, this chart from 2015 shows the HUI Gold Bug Index. So you see that gold had a strong support level HUI had a strong support level at around 170. 2005, 2008 it reached. It broke below it at the height of the gold's current bear market. However, it has jumped up to this level, come back down, and it's all, and it's again, it's on the prowl for the upside. However, what I want to show you in this chart is that this pattern is what we call a head and shoulders bottom. So you have the left shoulder right here. Head and shoulders bottoms usually come up after a major rise, such as this. And it's a bullish pattern. This pattern tells us, if gold breaks above this neckline resistance, which is the previous August high, which is 280, I believe, on the HOI, that we can actually see HOI shoot up to about 450. This is a very key level to actually to keep in mind. This chart, of course, is very bullish for gold shares. This other chart is also very interesting. We're actually comparing in this chart bear markets turning bullish within gold shares. So if you see the last time that we actually saw gold shares coming out of a bear market was basically from June 1996 to June 2003. That's the blue line. That's the movement of the HOI. And then if we actually get basically from the bear market in 2011 to today, and we index it to 100 so that they both start at the same level, you can see that the movements have been eerily similar, okay? And at this level, at this juncture where we are right now, basically you saw like in the blue line, there was this was around in year 5 of coming out of a bear market, you would see a consolidation that eventually broke off. Right now, if we see the red line, we're exactly at this point. So although, of course, this chart can't tell us that gold shares are going to rise this much, can't guarantee it, of course. Again, the resemblance between both bear markets emerging from a bear market into a bull market are crazy similar. And then, interestingly, within gold shares, the junior gold mining shares usually are the ones who tend to outperform the seniors, especially when gold's in a bull market. So you can see this uptrend since 2015, since gold had its first sign of a turnaround. You see that the junior index has been outperforming the seniors. This big decline, as many of you probably lived it in a way or another, is the recent decline. It coincided with the indexing issue of the GDXJ and an appetite for senior gold miners. This, of course, fell. The ratio fell, and it's actually nearing this support level, this uptrend. So if we have a C rise that's about to start in gold, and we have junior gold miners that actually tend to perform seniors during gold bull markets, and we're actually seeing that we're actually getting close to this apex, definitely junior gold miners is the place you want to be. That's going to present the best opportunities moving forward for 2017 and possibly for the next year. There are a series of junior gold miners that we follow. However, we also like the indexes. Even though GDXJ has had its indexing issue, we still like it. But if you don't want to mess with that, we'll also recommend the index called SGDJ, which is the junior miner index that Sprott manages. It represents the sector very accurately, and if you want to stay away from GDXJ because of the issues they've had recently, that's basically one good index that you could follow. So it would be SGDJ. We also like BTG. We like MUX. BTG in Toronto is a BTO.TO. MUX, which is McEwen Mining, is MUX, same in Toronto, same in New York Stock Exchange. We have other silver ones as well. Do we have some time? I have 2 other charts. That's it? Okay. Well, thank you very much. If you have any questions, I think my time is up, but I would be more than happy to talk to you right after this, and we could discuss any other issues. Thank you.